इसमें एक कोड आएगा मुझे.
I think Mr. Manu.
Yes, sir.
Yeah, it's now fine. Okay, so now we'll start, everybody. A very warm welcome to those who are already part of our family, and also to those who are attending our webinar for the first time. Thanks for having taken the time out and being here on a weekend. We really appreciate it. I am Romesh, Relationship Manager at Client First Asia, Mauritius, Dubai. As a part of our continuing series on the perfect recipe for retiring rich, our MD, Mr. Bhuvan Gupta, will be speaking today on the topic of an introduction to investing. The webinar will provide an overview of the basics of stock market investing, power of compounding, and the highlight of Buffettology. We will also look at the investment habits that we need to develop for wealth creation in the long run. We will be running a live question and answer session at the end of the webinar. If you have any queries in between, please post them in chat box.
Thank you, Ramesh ji.
Yes, sir. Yes, sir.
Good afternoon, everybody.
Good afternoon.
Welcome to the official series of Retiring Rich. It's the 5th series. We have done many webinars. Just to give a brief introduction about myself and the company. The company is basically a group company. We have operation in India. We have operation in Mauritius. We have a standing company in Dubai. We started in 2015 with a 2-member of team, like a lot of companies start with a garage. We also started from home. And then from 2-member to we become a 10-member team. We have an office in Al Khali Center in Dubai. Our Indian partners, which is a family with us, they started the Raipur operation and Bangalore operation. And then slowly we understood that the whole business is more about being the partner and the advisor than the broker itself. We got associated with Motilal Oswal 3.5 years back. We learned a lot of wisdom from Ramdev ji and Motilal ji. And we understood that at the end of the day, client want to make money and client want to also make sure that they are taken care of. Today, we are more than a 30-member team. We have advised till date more than $40 million. And our basic aim is very, very clear that we are here for clients. Who is there for clients? Some of the testimony to give it to you. We have helped a client to get an insurance claim when the company had said no. And we have also helped the clients when they had low confidence on the investing, and we have helped them to basically make money. Total, we are completing more than 5.5 years now. We also have, now I'm a registered fund manager with a Mauritius-based company called Client First Capital, where we are operating from. Our vision is to become a global startup. So you are more welcome to join us. You have a lot of this independent advisors who would like to join in, a lot of housewives, a lot of people who basically have a great mettle and they just left the work long back. They are more welcome to join us. We want to build a society of financial advisors, the advisors and the independent entrepreneurs. Our mission is to create high net worth investors. Here we are basically very much different. You would have heard about people managing a lot of high net worth investors. Here we are more about also creating high net worth investors. So it's basically a very collective model. It is also trying to save retail investors from a lot of exotic market. I will request all of you to make your microphone on the mute. And you would have heard about something called green revolution and white revolution in India. And now everybody has food. Everybody is able to grow crop. They have milk. Similarly, I think one most important thing which is being done by a lot of people who are from corporate in last 10-20 years is basically money education. A lot of us are still not educated on the money, what exactly money is, and that's our mission, and that's why we and anybody can join this session, and it is absolutely a purely on a education awareness basis. We don't discuss much about our products here. We discuss more about the basics of investing, and believe me, investing is simple, and investing is also difficult, but it is not easy, And if you try to make it easy, it becomes complex. So one thing is very simple, that simple things are not easy. Now, the commitment which we have is basically client comes first to us. It's a very important commitment which you have from every client, that the client comes first for us. In this company, we always make sure that the client comes first for us, and they are like our basically limited partners. Now, let's move to some of my introductions. So, I'm a fund manager now with a Client First Capital, which is regulated by FSC in Mauritius. I'm an engineer, a computer engineer, a finance graduate from SPJN College of Singapore and Dubai in finance. I have roughly 10 years of investing experience, where I have also burned my fingers and learned hard way. This third point I've already told to you. And I have understood now that the great people, the billionaires who basically have made it very simple, but some of us are not able to follow them because of our own individual behaviors, or maybe that is not making a lot of business sense. That's why people are not coming to you for a long-term investing, and everybody wants you to do a transaction. Let's discuss about some of the gurus of the gurus. So he's like our guru's guru, Benjamin Graham, who's a professor of finance, who I'm sure you do not. A lot of people know him with the name of called Ben Graham. He has written two books. One is the Intelligent Investor, and second is the Security Analysis. And these two books are like the Bible, like the Bhagavad Gita of investing. And Warren Buffett was very fortunate. At the age of 11, he joined him and he learned from him. And from there, Warren Buffett rose to a rank today that everybody talks about in the industry. So Warren Buffett is one of our Param Guru. I meet him every year in the US. This year I couldn't go because of the coronavirus issues. And he is called Oracle of Omaha. He operates from Omaha. You should know a little bit about these people because, for example, there is a very good saying my father says, that you cannot know about Bhagavad Gita or their principles unless and until you understand the hero of Bhagavad Gita, which is Lord Krishna himself. Similarly, we will not understand investing unless and until we'll understand the wisdom of Warren Buffett. For example, if you have to start a business and you want to know how business can grow, you should look at people who have done that successfully, and they have done it over a multi-decade period. Similarly, Warren Buffett is now roughly 87, I'm sorry, and he is basically the one who has compounded the wealth for 20% for so many years. He started with the Buffett Partnership Limited. By the way, more or less, we operate in a similar way, the way he was operating in 1957. Even Ramdev Agarwal or Motilal Oswal is a firm, and a lot of other firms actually are inspired by his philosophy of investment, which is a very low risk investing strategy. Low risk means not low volatility. Volatility is the part of the stock market game, but it's very, very low risk in terms of that you will never lose money over for a long period of time. But in the short run, you might have a notional losses of your money. He is the son of US congressman. I think all that you can read. Much about Warren Buffett, the wisdom quotes written around him. We practice that in our company. We are against leverage today. We are against margin interest. We would like to diversify. We do not do over diversification. All that we basically practice from him. And we also want to tell you that if we do not know what will happen to the market tomorrow or the next week or next 2 weeks, people increasingly ask me questions that what will happen next week, what do you think market will go up. To be very frank with you, even I don't know. And I just know one thing, that I can choose a good company for you and I can make you money in the long period of time, which could be 5 years, could be 7 years. And this model has a very low risk if you have time. But if you don't have time, this is not for you. So let's move on to Charlie Munger. Charlie Munger is also an interesting personality, and I think I'm following his wisdom right now. And I have read his book called Almanac, which I have not read yet. So Charlie Munger is 94 years old, and he has been like a silent partner behind Warren Buffett. But I think he has been more instrumental in running the company. There are two ways you can look at it. Warren Buffett has used to manage the portfolio of an insurance company called Berkshire Hathaway. Berkshire Hathaway is basically an insurance company. Every insurance company gets premium. That premium has to be reinvested pretty well. And that's what Warren Buffett used to do. And the operation has to be done, also has to be performed by somebody. And that's what Charlie Munger used to do, I believe. And Charlie Munger is also written something very good and very good wisdom quote coming from him, that whenever you take a decision, forget about whether you go, how much right can you go. Just focus on that. You should not go wrong. And that's what Charlie Munger's wisdom is coming. Then there is an Indian gentleman, which we have not talked much about, but I will recommend all of you to watch his video called Power of Focus, Power of Quality, Power of Compounding. And he has made investing very, very simple. And he's Ramdev Agrawal. And he's also called Warren Buffett of India, along with Rakesh Jhunwala. They both know each other pretty well. And he's a chartered accountant. He's a joint MD of Motilal Oswal Group. I want to tell you one thing very frankly. I don't know how many of you have had a patience of hearing Warren Buffett or Charlie Munger or Ramdev Agrawal. One thing I found very interesting about all these three people, because I've never heard Ben Graham, these people are so simple and down to earth. One minute, I think somebody. So I muted all. Yeah. So basically, these people are very, very simple. And this is what I've learned, that being at top, you can be still very simple, very naive, and you don't have to be somebody who has to be shrewd. And this is what I've learned from these people. Now, let's talk about what is our attitude towards wealth. So how have we divided this webinar basically? So we gave you the wisdom, we gave you the people you should read about, you should learn about, and discover an investor in you. Then now we talk about the present, that how our attitude towards wealth is, and then how investing has to be and what is to be avoided. So three parts we will divide investing into. First, we will tell you what is our attitude. Then we'll tell you what is to be done. We'll show you some practical. And then we will tell you what is to be avoided or what do we avoid. And that's how you have $1 million in the next 10, 15 years in your investing basket. So first of all, the driving factor is ignorance. So a lot of us basically are very ignorant about wealth. We don't have a wealth mentor. We don't discuss wealth on a dining table on a weekly basis. I don't think so. I don't have not met across a lot of people who share their investment with their wives. They both sit down and discuss. Even it doesn't happen at my house also, to be very frank with you, because either of the partners are not interested. So one thing if you can do, you can start educating your children or your spouse, and you start sharing those things instead of watching the so-called big boss of the world. We can also look at building some knowledge about investing by discussing that on a weekly basis, on a monthly basis, and sharing our existing investments with them, bringing them to the meetings when the advisors come to your house. So that is one thing which is very troublesome. Second thing is, we think, oh, balance sheet, oh wow, I can't know this, it's very intricate, it required maths, etc. Actually, it is not the case. Investing is very simple and very, very boring. So one thing is, we need to try to get a right mentor. I always believe mentor has to be there in life. Similarly, mentor has to be there for wealth management also. So we all should have one guru or one mentor who can help us to basically understand how the right investing has to be done. I'll give you a simple example. So if you get a, let's say, heartburn, or you get a chest burn, will you doctor yourself, or will you go to a renowned doctor in the vicinity and go and check yourself? That's about your physical health. Similarly, when you will not check yourself, and when you have a problem with the financial health, so you might be a good businessman, but that doesn't mean you are a good investor, because managing money requires more effort than managing business. So what you will do? Will you start managing on your own? No, don't do that. You should look for people who have wisdom, who can help you to impart their knowledge. I'm not saying they have to be your advisors. They could be your gurus who can help you that how they have invested, and they all will go wrong at some point of time, but overall picture, which is what you have to see. That's what I have done, and that's how I'm here. Now, third problem is information overload. When you open the newspaper, or when you just go to the internet, and you are not sure what to look at, what not to look at. So that's our problem. That also makes us less interested about the investing as a whole. Now, rational thinking, that's also very important. Are we rational? We're not. We all are emotional. We all are herd mentality. And there's a joke, basically. They say that the only strategy in the world works, dekha dekhi. I'll give you a simple example. I have a prospect. I've been following it for last three and a half years, but he was not ready to invest with us. One fine day, some other guy who was his very good friend, and he invested with us. And then he's told, even that person will invest with you. We just called that person and said, please come and take the documents. All I'm trying to say, there's nothing wrong with it, but I'm trying to say that are we really taking the control in terms of thinking that how this investing is working? Because unless and until we are able to figure out the right guy for you as an investment advisor or fund manager, unless and until we are able to rationally think about the how to choose, because we all have past experience and all have the bad past experience. But please understand, this is not only in investing, you also have bad experience in meeting the people. You also have bad experience in your own business. Does it mean you will leave that business? Does it mean you stop trusting people? But what happened? So I will tell you what happened with me also. In 2007, when I was in the stock market, we used to be in an IT company and we used to buy stocks because there's an online broker of ICICI Direct. We were just buying and selling shares. And what happened? The financial crisis of 2008 came and we just stopped doing everything and we just closed the trading window, and we never looked at it for the next 3 to 4 years. That is a very very irrational behavior. Now why it happened? Because it was just a trial and error. We did not take it sincerely, we did not take it seriously. That's why it happened. Now let's move to the emotional. This is what we do. So what I explained to you just now, that's emotional thinking. And now I'm discussing with you how you can be rational. You can be rational by taking it sincerely, make it a goal for you, and that's how it is possible for you to have a basically a good approach towards wealth. Now let's move on. Now, a middle class dilemma. Middle class always thinks of saving, saving, and saving. Now, do we understand what is savings? Savings is basically anything which is basically where we are. Just give me a second. So basically, savings is something where we all save, and we end up after 10-15 years, when we look at our savings, they are not able to help us to buy what we thought that 15 years back that we'll be able to buy with these savings. Like putting money into piggy bank, putting money into the bank. A lot of us send money to India and we think we are making 8-9%, but we forget that at the end of the day, if you get a guaranteed returns, they are not going to help you to beat the something called inflation. Yes, we call it mehengai in Hindi. Now all of you just think about it for a moment. I'll pose this question to you, that suppose today, what is the price of the chai? For, let's say I just put a chai here, or let's say I'll put a, I'm not very good at it, but let's say I put tea cost, right? Now 20 years back, the tea price in Dubai was 0.25 of 25 fils. In India, it was 2 rupees. Today, if you look at the tea price in India is 20 rupees, and Dubai is at least 2 to 4 dirham. And that's what, if you would have saved money in Dubai for last 20 years, you would have hardly made it 3.5 times. And because of that, your savings are inappropriate. And what happened with a middle class investor? 90% of assets are in savings. Mind it, even the real estate which you have, which is not a land, it comes under saving basket. And because of that problem, you are unable to cope up with the pace of the economy which has grown to. So please do not look for guaranteed investments. Don't go for a single digit investments which like 3 to 4%. You will never be able to come out of the middle class dilemma. But middle class, what is middle class here? We all want guaranteed safe return. The only thing I can tell you which is guaranteed is death. There is no other thing called safe here. So we should stop looking at the returns basically which are made out of what you call the guaranteed return, and we should now look at investing. Now what is investing? Investing is basically which beats inflation. Now what is inflation? Inflation, that if suppose you have, let's say for example, you have something let's say of a cost of this mobile. When the first mobile launched, let's say that was 1000 dirham. Today the same mobile is 2500 dirham. That's the pace of inflation. And I need to buy this because I now cannot survive on that mobile, because they have made my habit of using the mobile, which is basically very digitalized, or they have got a lot of features, etc. But investment will be able to beat the pace of it. Example, just now we would have read in the newspaper day before yesterday that Elon Musk, I think today itself has come, or yesterday it has come. Elon Musk, Warren Buffett, and our good friend, what do you call, Jeff Bezos, they all have roughly doubled their wealth in the last pandemic, which is investment. It is not gambling. Yes, it is happen very fast. It might go down, and after 3 to 5 years, you will realize it is still keeping 10 to 15% dollar return actually. And investment is something which beats inflation. 99% it is not capital guaranteed, but it is not risky as we think. The risky part is like a structured note and the options and derivatives and commodity, they are called speculation. So this is the middle class dilemma. Now let's go to the next slide. Now here are some very, very important concepts which we want to run through, and here we need your help, and I'm going to use my colleague Padmapriya also to that. Now my question to all of you is that let's understand what is power of compounding. Now power of compounding is the first thing I'll take it, and then we'll discuss the power of pricing. So power of compounding is eighth wonder of the world, and Albert Einstein, a non financial person, has basically given this. And this is a good decision. This is basically saying a few good decisions will offset the poor ones. Let's talk about it. All people who are hearing, listening to me, they all have committed some mistakes. But what happened is that suppose you have committed 5 mistakes and you have done 5 good decisions. They are not offsetting each other because your good decisions are not outweighing the wrong decisions. We all have taken decisions. We all have gone wrong. What about if your good decisions outweigh your wrong decisions? That could come as a blessing to you, and that is called power of compounding. So I have a question to all of you, Mr. Manu, Mr. Talwar, Babita. All I want to ask you a question. Please give us a company name which you are using in the, let's say, and it is publicly listed. This company could be from your drawing room, from your kitchen. It could be a restaurant you're going to. I'll give you some example, like it could be Gillette. It could be a clothing brand, but preferably US, because we are giving you, showing you a US chart, and you can type that on the chat window. So my colleague can see it and she can write it down in an Excel sheet, and we can show you the power of compounding and how it works. So I'll repeat to you what I exactly want from you. A one company which you're using at home. So I'll give you a very good example. Let's say we are using Boeing. All of you, when we go out and we have to travel, we have to use Boeing. You might be having a car, like I have a Lexus car. You might have a, let's say, GM. So I preferably want you to give me a US company. We can take HDFC Bank also, or ICICI Bank, because they are in the listed in dollar currency as well. So you all give us one company each, which you are using at your home. It does not have to be a company which you fancy about. It has to be a company whose medicine you are eating, whose restaurant, like for example, Domino's Pizza, you might like a Starbucks, you might like the, what do you call, company called Pizza Hut. So these kind of companies you can give. Try to give one company by each one of you. Chavi, Shilpa, we have more people here. Menu, Taral, Mr. Kumar is also on the call. Thank you for coming. Rohit, please give one company, and Priya will basically share with you how basically it can work wonders for us. Only few good decisions will help us, and I will show it to you. Now, power of focus. The power of focus is saying that industry. So whenever you invest, you have to look at an industry which is growing. For example, trading community is shrinking because they are all like middlemen. And after the power of digitization, the trading community is shrinking. But digitalization is a great place to be in. Like yesterday, I think somebody forwarded me Reliance chairman, Mr. Mukesh Ambani, and Facebook's CEO's interview. And I think he was telling a very good message that the pace of digitalization has really increased. So I can promise you one thing, guys, if you are not using internet, if you're not making internet channels as a business, for example, look at us. We are using Zoom right now. I'm using Google Slide or Google Business Console. I'm using MacBook. All these companies are helping us to communicate at a very, very low cost. And that's basically industry. So we invest, or you invest in a company where, in the industry where the pond is increasing. For example, oil industry, it's not growing. You should avoid a company in the oil industry because slowly, or let's say fossil fuel, or let's say coal industry is a very good example. You would have not heard about many coal companies. So this is the place you should avoid. You should be in a place of electric cars. You should be in a place of a company like, for example, the online signatures, where now every documents are digital signature. So that's power of focus. And second thing, don't invest in an industry which you don't understand. For example, I don't understand biotechnology. I did not invest in a company where the CEO was a lawyer, because I don't understand how a lawyer will work. So you need to be very focused that you should not invest in an industry which you don't understand. So I have invested in a company in my portfolio which was very, very lucrative, but I'm still studying the industry, whether I should keep the stock or not, keep the company or not, because that industry is not really very known to me, but the pricing was great, the financials were okay. But if I am not confident, I will sell the company. So you should also focus on a few industry. Don't try to buy everything, like I want to buy Neo, I want to buy Nicola, I want to buy XPay. No, this is not a flirting exercise. This is a marriage exercise. So you need to be focused. You need to see that whether I will be holding this company even if the company goes 50% down. It's very simple. Some of you are businessmen here, or let's say you're in the job with me, or somebody. Tomorrow, if there is a fight between you and me because of this, something does not go right, will you leave me? Are you okay that if your boss is not happy with you for 3 to 6 months and you still work for that company? Similarly, if that is the case with your investment, you be into it. Else, don't invest and read more about the industry. If you're not comfortable, go to a industry which you can understand. For example, Chipotle restaurant of the US, a very simple company to understand. So I hope you all would have given the stocks to Padmapriya and in the chat, and we can show you that. Now, one more thing on the power of pricing. Now, I have been heard, or I have been told by many of my investors that, Bhuvanji, the Amazon is 3,300. Do you still want to buy it? The company which we bought and it's become 3 times in the portfolio, and now it is 60, 65 or 69. And they are telling me that, do you think it's still a buy? I will tell you one thing, that please don't think of in terms of price. Price is just a number. So Warren Buffett said, value is what you pay and price is what you get. So you need to look at, if I put some money into this company, how big it can be. So I always want to talk to you in market cap. Don't talk in price. For example, Amazon market cap is $1.6 trillion. Can it become $3.2 trillion in the next 3 to 5 years? If that is yes, then I should invest into the company. One of my company which I bought has a market cap of now 6 to 7 billion now. Can it become 20, 30, 40 billion? Yes, I think it can become, because it is growing. Why should I sell it? So power of pricing, power of compounding, and power of focus is what you need to be focused on. They're very, very important concepts. Believe me, this webinar is very, very simple. There is no rocket science required to you to make money. It is only thing is that you need to read and cut the noise. These are the concepts. You can just go to Google or YouTube and you can write down these words and write down Ramdev Agrawal and have a patience of 1 hour or 2 hours. And you have to listen to him again and again to get these things right. Good wealth come with a lot of patience, guys. I have customers who are making 70, 80% in the portfolio. I'm not selling because this portfolio is not made for a year or two. Okay, now for a moment I'll stop sharing, or maybe let's say let me go to the investor education. And before we go to the Priya, have you done that? Priya, have you done your work?
Yes, Bhuvan.
Okay, great.
These are the companies.
Okay, thank you. Now, before we go to it, the power of compounding, which I have mentioned here, is very important. So half an hour, I'm on time. Now, please understand there is something called rule of 72. And rule of 72, I think I will not explain it to you. We'll just run a YouTube video, which will be very easy for us to understand. Rule of 72 is basically used by all the good investors to remember when your money gets double. So rule of 72 is a very, very important concept. All of us should try to understand this. This is a very, very simple concept. Let's do it. Let's watch it.
Here are 3 pieces of advice from eToro users on how to trade safely during a period of increased market volatility.
So you've got a chunk of change, and you're smart enough. So you put your money into an account that gains compound interest. So how long does it take for your money to double in that account? Well, to find this out, you need two things, your balance and your interest rate. Now, like most things, there's an easy way to find your answer and a hard way. The hard way involves taking the logarithm base 10 of 2 as in 2 times our balance, over the logarithm base 10 of 1 plus our interest rate. Since most of us don't have bionic brains, we can't really do this math in our heads. But our friend Larry is here, and he's going to give it his best shot. We'll get back to him later. Luckily, there's a simple way to approximate how long it takes for your money to double in a compound interest account. It's called the Rule of 72. How does it work? It's surprisingly simple. All you do is take the number 72 and divide it by your interest rate. That's it. It's that easy. The number you get equals the number of years it's going to take to double your money. So let's try it out. Say you have $5,000 in your account earning 4% interest. Now take that magical number 72, take your interest rate of 4%, pull out your phone, text your second grade cousin and ask him how many times 4 goes into 72. He's a bright kid, so he'll tell you the answer is 18. And you'll tell him that he just helped you learn that it will take 18 years for your initial $5,000 to double into $10,000. Let's check in on Larry. That's very nice, Larry. Luckily, with the rule of 72, there's no need to ever use the hard way. Using the rule of 72, we can easily see how small changes in interest rate can make a huge difference in our earning potential. A 29-year-old earning 4% compounding interest can expect his account to double twice by the time he's 65. At 8%, it doubles 4 times. At 12%, it doubles 8 times. So by doubling your interest rate from 4% to 8%, you actually quadruple your money. And by tripling your rate from 4% to 12%, you 16-tuple your money. Is that a word? It is now. Interest rates matter. The rule of 72 helps us understand just how much they matter. So how many doubling periods does your nest egg have before you retire? Now you know the easy way to find out.
Thank you, guys. So basically, this is a very important and very, very important focused concept called Rule of 72. And you have this here gold and bond and fund and business and credit card. Why do we all make a lot of money in business? Because we make sure that business grow by 20% or 15% or 30%. Amazon is growing by 37%, by the way. And let me show you how Amazon can work. So if I put Amazon here, and if I put 37% here, look at it. In 20 years, my money can become 542 times. That important is the concept. And if you go back and check Amazon, something like that they have done. And that's what we tell our investors, and we go and talk to them and we put in their head. And if you would have taken a credit card and you would have paid minimum payment, or maybe 36%, sorry, this is the same way you would have lost 468 times. That's how the banks make money. Today, I tell all of my customers, I'm anything, I'm anybody, but I'm not a banker, because I don't want to sell you something where you are actually looted away. So we are risk averse in terms of loans. We are loan averse, debt averse. So this is the concept of power of compounding, rule of 72. You can use it, you can understand it. If you don't understand it, it is going to take your hard-earned money back. So if you have a loan from the bank, you exactly know what you're doing. The problem is not in the loan. You could be like Warren Buffett, who might be taking some loan judiciously. You could be a big guy. You might have to take loan because of the business fee, but it makes you weak, because what happens is when you take a loan and the bad time like Corona comes, you are not in peace, but you are actually cut into pieces. But if you don't have a loan and the coronavirus comes, you can actually take tons of money and invest and make a lot of money, which what we also did, but we didn't have a loan. So I have a request to all of you. If you have a high interest loan, please pay it off ASAP. Now let me go back to what Priya has done for us. Priya, thanks a lot. Now the sheet called USD investments. Yeah. So this is what Priya has done for us. Like, for example, some of you have given Amazon, names are not mentioned, it's absolutely fine. Somebody gave Unilever, somebody has given HDFC Bank, Microsoft, Apple, the company called Gap, IBM, Cisco, Adobe, and Pepsi. So you see there, nobody gave Facebook, nobody gave Tesla, nobody gave Apple is there, Amazon is there, Google is not there. So it's a very balanced kind of a approach. And now see, I am not going to do a transaction. I'm not going to sell. What I'm going to do for you is I'm going to put 10% each in all these companies, which I actually do for my portfolio, which actually you can do also. and I just will leave it for the 10 years. And why I will leave it for 10 years? Because I want to show you the power of compounding. So today is, let's say, 23rd of December, or roughly today's date is what? Roughly, let's say 10th. We'll take 10th. And I go back 10 year industry history, and I make it exactly look like we invested 10 year back, which is, let's say, 08 2010. Now you look at the returns which we made is basically 10 times, and it is basically on $1 million. Somebody invests as a layman, no fund manager involved, no advisor involved, no private banker involved, and you end up making $6.6 million plus dividend. And that's what 20.94 staggering return for you on a yearly basis. And that's what exactly we have learned and we are doing with our clients. We were not doing that earlier. Let me accept that. We are also not been taught this. Banks don't teach this. They're all just telling us go out and do their targets, maybe some incentive we get, and try and help the client make money. But when they don't educate us, these kind of problem happens. So I showed you that how this has changed the life. And look, you have not made money everywhere. You lost in IBM, a bad decision. You did not make money in Gap, a bad decision again. So this is what we are talking about. Even if you have taken two wrong companies, even if you have taken an average company like Unilever, I'm sure Unilever would have paid at least 4.5% dividend. We are not even discussing the income right now. We're discussing the capital appreciation. So what I'm trying to say that if few companies have done great, this is the money what somebody could have made in the 10-year period. Now let me show you what happened in the March. Very, very important concept. So power of compounding I taught you. Now I want to tell you what happened in March. The bad day of the March was 23rd March basically. So if I go to 23rd March and I want to look at the returns. Okay, 23rd March, wait a minute. So this is basically 03 and 23, I believe. Okay, so if that is the case, yeah, it's 812, it's fine. Now 23rd March was also, I was making $4 million. But let me show you what happened to 23rd March. So S&P 500 share price. 23rd March, if you go to this slide and we see 23rd March, this was the worst period of the history in this year when the S&P 500 was the lowest. Even in that particular scenario, I am having a 15% return, and that's what about time in the market. That's what I promote to people, that please don't time the market, spend time in the market. The only foolish thing anybody can do is to stay out of the market and only look at one portfolio at one go. You should keep putting more money, and you should be very much aware that this is a stock portfolio. It will take some time. Why I'm taking 3 years, I will tell you, as 10 years. Now this is 10 years, right? But if a customer would have invested in 2017, does he make money? See, he's not making money. That's the point I'm trying to draw here. If somebody had given money, oh, sorry, this is not this is actually 2.5 years, right? So yeah, it is 2.5 years, 17 complete, 18 complete, 19 complete, it's 3.5 years actually. 18, no, this is 2.5 years. So you look at 1 million has only become 1.059. That's a very, very low return. But if I convert this into back to today's date, then is the return what you do. So basically the problem in this market is you have a volatility where the market goes down and it might not come up for some time. And that's why we are not suggesting any one of you to look at this investing for short run. Now let's change the horizon to November or December, and let's see the value now. And if you look at the value now, and which is basically 3 years, we are looking at 20%. See, we are roughly doubling the money again in 3 years. And that's the reason we are telling you not to look at this market for minimum less than 5 years. But look at in the 5 years, you're still losing money on a company called Gap. You're losing money in the IBM. You are not making money in Unilever. You are not making enough money in Cisco, but still your portfolio is doing amazingly good. It has the human error and it is still making money. And that's what we want to share with you. This is something we're going to share with you. You can use the companies which you have. You can use this for Indian market. You can use it for China market, Russia market. It will work wonders in all the market. There is a reason behind it. Anyways, let's go back to our slides. Not much on this now. So power of pricing, power of compounding, power of focus. We discuss important concepts. We discuss how is our attitude towards wealth management or wealth or our own wealth. We don't discuss wealth in our home. We discuss about the legendary gurus who have helped us to think about this for a long term and select stocks for you. Now, figure out what next I have for you. So I have a tap on timing. I have 15 minutes left. Now, why we don't become rich? Again, we are stressing on that because we think it's speculation and gambling. I'm not investing your money in a black horse. I'm not, or you are not doing that as well. We are looking at the business first and then the company. Looking at the quality first, then the management, and then the stock market pricing. People have past experience, as I told you. Like, for example, you have burnt your fingers because you have done some brokerage, some trading, some margin trading, etc. And that's why, again, you don't want to come back to the market. Time in the market is a very important thing. I want to tell you something. Do you want to become Shikhar Dhawan, who played 1 or 2 match in the World Cup and then he couldn't play because of his wrist has got problem? But the 12th man who played more match up to the quarterfinal or semi-final, and he actually ended up making more money without even playing a game. One way to think of this. Second way of thinking of from cricket, I'm sure you are a fan of cricket. Virat Kohli, who has to hit a century, has to take a lot of single run. If you look at single run, have a lot of contribution in the hundreds. They're always in at least 40 or 30 single run in a century. Markets don't make money every day because it's all about information flow based on the fundamental. But as you do not know the bad days, you don't know the good days as well. Like, I did not know from September to November, my portfolio ran 20%. I was not aware of it. But one thing I was sure that I have to play the game because I have to be in the game for long run to make money. The fundamental rule of investing is invest when you have the money, which you can forget about 8 months to 3 years. Take the money when you need the money. Don't wait for a taxation benefit or 5% or 3% gain. Whenever you need the money, take the money. That should be the fundamental rule. Now, guarantee. The risk, there's something called risk-free rate. I'm sure the US government bond or treasury notes are called risk-free return. But now somebody has said, because there's no return actually, you're getting 0% of the US fixed deposit with the bank. Now they are saying that it is return-free risk. And basically you're getting no return and it's a free risk for you. And that's what people are saying now. This is very important, short-term focus. So a lot of us are traders basically. We buy and sell every day. And because of that, we also want to make money in the stock market in the short run. And believe me, nobody has gone right except the professional traders, which we are not. This is the reason why people don't become rich in the stock market. This market really works very differently. So if a stock is going up, it is time to buy it more, not to sell it. But when a stock goes down, you might have to cut the losses because that stock or the industry might not work for the next 3 to 5 years. Example I'll give you. Warren Buffett sold aviation company in March. He did not look into them that time. And then he started entering into other markets. But what we would have done, we would have not sold our aviation company and would have kept them and thinking one day it will go up, and etc. etc. That is the learning which we should have from him. Now, most people would rather rely on the promise of getting rich tomorrow than the certainty of getting rich in 20 to 30 years. So this opinion is very important. So Jeff Bezos was having lunch with Warren Buffett and he asked Warren, your strategy is so simple. Why people don't follow it? And Warren Buffett answered that the problem is it's not only simple, it's also boring. Nobody wants to retire rich, like watching a paint dry on the wall. And that's the basic challenge. So I have made this year, let's say for clients, 40-45% on an average. But do I want to exit? Do I want to keep my money in cash? No, because the game is just beginning. And 1 year does not say I'm a very good fund manager. It does not say I'm a very bad fund manager. But 10 years experience is telling me that I don't want to be in debt. I want to be in equity, and I want to be investing for myself for years to come. Now, simple rule of stock picking, something called economic moat. I'll quickly tell this to you. Economic moat means the advantage. For example, regulation advantage. You're an insurance company, you're a mutual fund company, you are a stockbroker, you could be a bank. This is a moat, an unique advantage. Let's say, what is the advantage Amazon has? Amazon is one of the biggest online retailer in the world. What is the economic moat Netflix has? Netflix is one of the best content driven company in the world when it comes to the digital viewing or home viewing. I ask my children, very simple thing. I ask them, beta, what do you want? You want me to play Netflix at home or Amazon Prime? Which subscription do you want? They all shout in unison, Papa Netflix. And that's the economic moat. Second thing, very important. Look at the differences of the returns. We have seen this. A founder is so passionate about the company. They are so passionate about the company. I'll give you an example of one of my very good client, a friend. I told him, sir, what time you come to office? He said 9 o'clock. I said, that's very good discipline. He said, if you don't take care of the business, business will not take care of you. He's a man driven by his passion, and he comes at 9 o'clock and he makes money for the last many years. So founder has that passion, like the passion I will have. Only and only owners will have that kind of passion, and that's why you should look at a stock that's driven by owner. For example, Elon Musk. Sometime back he said, "I think our stocks is overvalued." Who says that? And that's Elon Musk. So you should look at a company just founder driven. Third thing, do you think Elon Musk is interested to sell his company? I don't think so. Do you think Amazon, Jeff Bezos will sell his company? No. They have a big vision. They want to go to Mars. They want to go to space. They want to design a rocket which can come back. They want to design a car, which Google, for example, the owners are still there, right? And they're conservative. That's very important. Warren Buffett is very conservative, but he's not conventional. He has cash, but the cash he will not put into, let's say, a 5-year fixed deposit. And they're missionaries, they're not mercenaries. People tell me Warren Buffett is a bad guy. I said, why? He has got $60 billion. He's not spending any money. I said, look, he is a missionary. The money does not motivate him. He's already given a lot of his money to charity. What motivates him is the mission, and for that mission, people have written so many books. I think if Warren Buffett would have not been there, I would have not exist. So that's very important. We have already covered founder style. Strong financial. This is something technical, but you can get these data also very easily. Return on equity means how much owner has invested and how much return they are getting. Second thing is cash flow from operation. A very important lesson for all the businessmen who are attending here. You might have the profits, but you might not have the cash flow. Profits disguise you. Cash flow is a reality. Cash is the king. So basically, the most important thing is cash flow, and cash flow. So cash has to come on time. Cash has to, whether it can go a little bit late, but it has to come on time. Third thing is the value buying, like PE ratio and EPS. They're not very important, and I should not be taking it because that's not so simple. Work culture, that's very important. So we have a company on our portfolio. I'll not name the company. We wrote to them that how do you make sure that your employees are retaining with you? Retaining of employees are very important. See, understand, when you're listening to me today, you're basically betting on a relationship manager or a friend of yours who have recommended you to this webinar. So basically, you're liking that person. That's why you are giving time to listen to me. Similarly, when you, if at all tomorrow you will invest with us or you will agree to our philosophy, it will be all about investing on us, whether you invest monetarily or you hear our advices. When I will invest in these companies, I will look at the work culture. Netflix has such an amazing work culture. You can take n number of leaves you want. In the pandemic, Amazon went ahead and increased the fare. They are so flexibility now. Right now, I think I forgot the name, but I think Microsoft and Nokia, you have so much flexibility. You can work from home. You don't have to come to office for next 1 year. So work culture, how you choose your people, how you take care of them. It's all about people. Today also, we are also doing the same thing. We are trying to make our whole team or all employees think, and we want to make them partner in our success. And that is very important when you do a stock picking. Now, if suppose you want to choose an investment manager because you don't have time, It's a big portfolio. You cannot do it on your own because you're busy. You need to look for somebody who basically put his money where his mouth is. For example, we invest our money where your money is. Warren Buffett does the same. Ramdev Agrawal does the same. You have to look at the money managers who are entrepreneurs by profession, who are a businessman, so they understand how business works, and they also are part of the strategy which they're offering to you. The second thing is, how do they protect the investment capital? Are they buying risky assets? Are they churning? Are they leveraging? Believe me, one thing which will prevail is the value investing and growth investing. All this arbitrage and this and that, somewhere people will get disturbed because it is too much of transition and too much of a headache and too many frequency trading to be done. Keep things simple. That's the most important lesson I want to give everything. Keep things very, very simple. Experienced fund manager. You need people who have got good experience of 5 to 10 years in the industry of making money, because they would have seen the downturn. For example, I've seen 2008, I've seen 2020, and I've survived that, and that's a big thing. A lot of fund managers cannot survive these kind of crises. So a lot of fund managers lose their reputation because they are not able to survive the downturns. So upturn, everybody can survive, but there is a saying that when the tide goes down, you will see who is swimming naked. I'm happy that at least I am not swimming naked. Transparency and ethical compliance is very, very important. You need to look at people for their transparency. Like, we have a very transparent structure. We charge everything to you and everything is shown on your statement. Similarly, please understand, if somebody tells you it is free, it is not free. There is no free lunches in the world. So transparency is the key. You should always understand how much the other person is making out of what you are giving it to him. Because if he's making more money, he might give you higher risk. You might not want to look into what he's doing, but he is giving you higher risk. And ethical compliance. The most important thing is complying with the ethics. And that's what you need to look at when you look for a person. Now, what we should avoid, we just discussed, and I will just stress on this. Now, look at one thing. All this news which you can see, the one reason why people are not able to be successful in the business world or in the investing world, because of the high debt. So debt within the portfolio, debt within the business, debt within the family is a big problem. Please don't get greedy. Greedy people don't make money. Don't leverage your portfolio, because leverage is just gonna kill you and not gonna make you money when you exactly need to make money. Leverage will also make you so uncomfortable that you will take a wrong deal, or you will take a wrong decision. Today, I might not have a big bungalow. I might not want to have one, but I don't have leverage. I sleep peacefully. I've seen so many people leaving Dubai. I'm sure you would have also seen them. And the one reason was they want to become rich very, very fast. Becoming rich fast is not going to work the way Warren Buffett has done it. Elon Musk is now also 50 plus. Most of the wealth of Warren Buffett was only made after 60 years of his age. So please understand that greed and leverage has to avoid at all the cost. As per Warren Buffett, if you buy things you don't need, soon you will have to sell things you need. That's what Warren Buffett said. I have 3 minutes left. And now more on the leverage, which we'll share with you. So you can increase your returns, but your mind will be very greedy and you have to sell things which you don't want to. Basically, you cannot afford to have them. So why Warren Buffett has aversion to leverage? Because they predict that a very higher percentage of that smart people operating in Wall Street at one time or another are likely to get clobbered through the use of leverage. So he knows that there are very smart people in the Wall Street, but you get biased and you get clobbered with the tool of leverage. And that's why it is not advisable. So please stop using it. I know it's very, very freely available in the US, in the UAE. Brokers are luring you with the leverage option. It is not to be used, actually. It is not required to be used, in fact, if you ask me. So I'm done with my presentation, guys. And now time for question and answer. And please ask your question yourself or type in the chat. Priya will read for you, and I will answer to that. I hope it made sense to you. It's a very simple investing concept. But you have a specific question, please shoot. I'm here for you. Before you shoot your question, I want to tell you, we have done a very good job this year. We've touched 40% plus, but in a gross return. But we always tell our clients that don't look at more than 10 to 15% return, and that's a great return to actually look at in the long run. I will try my level best, but this is not what people should make a standard to. This has been a fantastic year so far, and we are very optimistic for the coming year, and we are very much prepared for the crisis which is going to come. And whenever it comes, we are very much prepared. So your questions, and I'm here. Please speak freely and unmute yourself, and you can ask me directly.
Bhuvan, one question from a participant. Like US elections are over and the markets have rallied. What do you foresee for the future markets in the near future?
So the question is near future. So if you talk about 5 years, I see market to get double from here. Okay, and when I say market to get double means the good stocks. I don't mean the index. Index is for the average. But if you mean the next 3 months or 2 months or 4 months, all I can tell you that we should be worried about, or we should be cautious about the US taxation. Nothing much on that I can tell you. But in a 5-year window from here, we are seeing a good growth in good companies. I hope I answered to your query.
Yeah. And one of them has asked, is Shark Tank a good show to educate oneself about investing?
Shark Tank.
Yeah, it's a show actually.
Okay, so I'm not aware of it. You have my number, or I think it will be there, or you can take my number and share with me on WhatsApp. I'll look into it. If that is really helping you out, I will also get some education. What you can do, in fact, of that, I just told, you can watch Warren Buffett's videos if you love to watch video. You can watch Ramdev Agrawal's video like Power of Focus, Power of Quality, Power of Compounding. You can go to Twitter, and there's a guy called Chris Mayer. He's an author of the book called 100 Bagger. You can watch him and see him. That's what I do. I have George Gammon. I watch him. There's a guy called Jim Rogers, amazing businessman, and he buys things slow. He's also influenced me a lot. But coming to Shark Tank, I'll make a note of it, and why not? I will see it as well. But I have no idea about it.
Another question: if I'm getting 70 to 80% in the short term, why should I look for long-term investment?
The question is, I know only one person I have made 70-80% this year, or sorry, two people. So very simple thing. What money you have invested, is it helping you to retire, first of all? Second thing, do you understand that this 70-80% is now your capital? Now, do you want to say goodbye and you want to retire? Take the money. But if you want to look at 10 times, which I just showed it to you, then you should think how this can also grow next year. I'll give you a very simple example. This made you 70% return this year. Why do you think this will not make you a 20-30% in next year? You also know it will not make you 70% return. Coronavirus crisis will not come again. It happened in the 10 years. For example, the last crisis came in 2007. So if you want to wait for 10 years for a crisis, then you should take it out. But if you are keeping your expectation low and you think this is not helping you, so let's say you would have given $100,000, it's become 180. Is this $80,000 enough for you? Take out the money. But if you think that you want to invest more and learn this and make more money, then you should not take it out. So it's a very subjective choice. Maybe one-to-one we can meet. And I don't know who is this person, so I am unable to, because unless I do your KYC, unless I understand what you have done, what your requirements is. But let's say you have a requirement to pay off loan right away, and you are not happy with the loan, go ahead and pay the loan from that money.
Okay, another question is, why do you prefer US stocks to Indian equities?
Okay, so there's nothing called US or stock or Indian equities. As I told you, returns are there everywhere. So this is a very good question you have asked. Let me answer this to you. I have a lot of Indian partners who are already investing in India. They are having 10 years of experience, and some of them have not made money for us in 3 years. In fact, majority of them have not made money in 3 years. US, we have made a lot of money because money printing has happened like crazy. Interest rates are zero. Indian market is also a great market to look at. China market is also a great market to look at. I don't invest in the US. I invest into the companies which are having great opportunity. But do we know much about other markets? Doubtful. So I have one company in China, I have one company in Canada. I might buy a company in Europe. I might buy several companies in China tomorrow. I don't have space in the portfolio. But let's say, for example, I bought a company called Skechers in my portfolio. You need to go and look at the business. Skechers business is growing in China, not in the US. I have a very good friend here who works for L'Oreal, and L'Oreal growth is coming from China and not US. It was coming 5 years back from the US. So we have to understand one thing very well. When you invest in a company, it's not the country. It could be multi-country growth. It could be trading in the US dollar, but it is actually a global investment. So if you ask me my portfolio, where a lot of companies are from the US, but I will say we are at least 40% in China today, because China is a market is growing. For example, Tesla, you will buy in the US, but growth is coming from China. Porsche, or let's say Porsche, if you will buy a Porsche in Germany, the growth is coming from China. So please understand, I'm not saying that you should invest in the US company. Look at the company which can grow at 20-25% for the next 10 years, and that's your company. I hope I answered your query.
Sorry, I was muted. What is the best time for investing?
Today. The easiest question. I'll ask you a very simple question, a cross question. What is the best time to get a salary hike? You will say today, right? The best time to invest is today.
So far, you've answered all the questions, Bhuvan. If anybody has any other question, please post it, or you can unmute and ask the question.
Please ask questions. I understand you must be having anxiety. If you have made money, you have anxiety. If you have not made money, you'll have anxiety. Ask questions. We also learn from your questions, actually. No question on the gold. Nobody wants to ask on gold. Nobody wants to ask on dollar value.
Okay, one has come. Which asset classes do you think are undervalued today?
Okay, overall, the commodities are undervalued today. So if you go and make a chart of S&P 500 versus commodity index, it is one of the lowest after 1987, because they have printed money and they have inflated basically the assets. But commodities are all-time low today. So sugar is one of the commodities very, very low. Coal is very low. Oil has just gone up. I have invested in the oil industry, and people were against me when it was 35. Today it is already at 42, 45, I believe. And there are chances it will go further up. So commodities are actually at a very, very low price today.
How much capital should we start with?
Sir, it's a very subjective question. I will say, please meet one of our financial doctor and get your KYC done. And based on your risk appetite, your requirement, your goal, it's like, how much surgery I will do it for you. It depends on the wound, right? If you have a small wound, you might not need a surgery. So I need to know you more. So please fix up an appointment with us if you like us, and we will be happy to help you out.
If one has 100K, how to allocate between equities, gold, and real estate?
Again, if you have 100K, is it the all wealth you have? So let me try and answer your question. Suppose you have all the money as 100K. It all depends on your risk appetite, your age, your retirement goals, and what you want to achieve in life with this money. If I would have been at your place, I will only look at $20,000 or $30,000, depending on how much money I need for the next 8 months, or let's say a year or two. And if I'm earning money every month, then I might not want to keep more than $10,000, $15,000 aside, because I know that $80,000 which I'm investing in the stock market will not become zero, because I am not gambling with the money. I'm not speculating. So I will say that people like me who has a different situation, I'm not suggesting you, but since the question has been asked that way, I would put $85,000 into the equity straight. Your case will be very much different. I'll again say, please meet with us one-to-one to understand your requirement, and based on that, we can guide you.
How safe is investing in Bitcoin? And do you want to comment on its future, or it's just speculation according to you?
Okay, so I'll not comment on Bitcoin because I still feel I have not got time to read about it. I heard it's one of the great thing, and some of the billionaire investors are involved, because it is offering us two things. One is it is offering us the speed, and the second thing is offering us the low cost. So let's understand it. I'm not commenting on Bitcoin. I'm giving you an idea. I'm giving you a direction actually, and I have heard it from Mr. Draper. He's a billionaire who has invested into Skype and all. He runs a school called Draper University in the US. So MasterCard and Visa card, everybody use it, right? And you would have seen that when I asked you for the companies to give, none of you gave MasterCard and Visa card. But I can tell you, if you will look at American Express and MasterCard or Visa card, they have given you phenomenal return last 10 years. So they have all given you 10 times plus return. You can just check MasterCard, Visa, and American Express. They've done a fantastic job. What do they do actually? They help us they have basically helped us to read off the cash we have in the hand. We don't have to go out every time and take out the cash. We can just swipe the card. Basically, they help us with the cashless transaction. Now, what Bitcoins are helping us basically with two things. One, or let's call it cryptocurrency, because Bitcoin is one cryptocurrency. There are hundreds of cryptocurrency. Let's discuss only cryptocurrency. So in cryptocurrency, what happens? You can, let's say, for example, tap this to, and I can just pay you. Today, what happens? They are showing a advertisement in the US that if you are not paying using credit card and somebody is paying through cash, the whole assembly line get disturbed. So Visa and MasterCard are the same concept called fast, efficient, secure, and low cost, because they give you a lot of SOP on the credit card as well. Similarly, cryptocurrency is offering you, you know how much we pay actually when we swipe a credit card. If you would have bought gold, this gold merchant does not allow you to pay by credit card because they say you have to pay 3.5% transaction fees. Cryptocurrency is offering you that also at a zero kind of a cost. And they have a great efficiency, and you can actually store your money in the wallet. Now, the problem with cryptocurrency is it's at the end of the day called currency. Since it's a currency and government regulates the currency, this could be a way to doom. So I will say you should look at blockchain, you should look at blockchain stocks. And I have very limited knowledge on cryptocurrency. And in some of the countries, including India, it is banned. I have no intention to invest into cryptocurrency. Digital currencies are coming. Governments will take it over. That's my opinion.
Okay. So one participant is asking that we had asked them to give the companies and looked at those 10 years ago, like starting 10 years ago. So what is the growth of top 50 companies 10 years back and now? As we are today remembering successful companies and looking back, but want how 10 years back successful.
Okay. So I think I totally got your point. So if you look at IBM was there, and since IBM was there and IBM did not grow in the last 10 years, so you would have your queries coming in, you're basically telling that how to know which are the next 10 companies which will grow in the next decade. Your question is also to say to us that you would have showed to a successful company, but what if I would have invested into GE, IBM, and those days successful company like the industry or the manufacturing company, I would have been losing money. And that's essentially the point. When we make the portfolio, we don't buy Amazon and Googles and Apples and the Facebooks of the day. Yes, they will grow. But we buy companies which can become Amazon, Apple, Google, and Facebook. And how do we do that is basically the whole science, which we told you in how to pick a stock. We don't buy a 100 billion or $300 billion company. We don't buy that because we feel the story is already done. We look at these companies to understand what was going right with these companies. So you're absolutely correct that they also say that top is slippery. So no single company can say that they will survive for 100 years and you can just blindly put it. For example, McDonald's or Pepsi or Coke. If you look at for the last 10 years, they are actually behaving more like a bond and not like a stock. Maybe Starbucks from here also behave like a bond. So you're absolutely correct. And that's why it's not easy. But the pattern you can understand is from these companies, and then you can apply into the companies. And even if two companies, for example, if we talk about our portfolio to give answer to your question, one of the stock in our portfolio has become 30%. 300%. Let's assume we had 10% allocation. The 90% portfolio is as it is. One stock become 300% is actually giving us 20% return. That is what is happening in the investing. So I totally understood your point. And the key is to look at the companies, the past performance of the big companies, to look for a small fishes which can become like that. For example, let's take some example. Tesla 2 years back was a small fish. Shopify 2 years back was a small fish. These are the companies which were showing the same traits what the fangs have shown to us, or let's say what those 20 years back G and all and IBM have shown to us. I hope I answered your question. This was a long one, but that's what I think you meant.
Yeah. One more. You mentioned capital safety as one of the goals of your fund philosophy. This is very important for middle class investors who are scared of stocks due to past experiences and hearsay. How do you ensure capital safety for our hard-earned money?
So I diversify into 10 companies to 11 companies. I also buy counter-cyclical companies. For example, we have a view that gold is undervalued. Dollar goes down, gold goes up. So we bought a gold mining company in your portfolio, which we'll buy actually for some of the customers we have not bought yet. So what do? We diversify so that the negative correlate company does not let you lose money permanently. We don't speculate in the startup companies. We are not saying that we will buy a company which is less than 10 years. So our philosophy is that we will buy a company which is minimum 10 years. There's a research, 96% companies fail in the first 10 years. So first of all, we are already eliminating those companies by not investing into companies which are less than 10 years. Second thing, except this year, we look at the companies which are at least gross profit profitable. Third, we look at companies which have been growing by 15-20% in the last 3 to 5 or 10 years. Fourth, we look at the companies which makes money 24/7. Fifth, we look at the companies which are run by founders. Sixth, we look at the companies with minimum $1 billion in net worth. Minimum $1 billion in net worth. Seventh, we also look at their risk rating. Eighth, we also look at us being their consumer. For example, this shirt which I'm wearing, it's from Stitch Fix. Now you can't order in in Dubai, but you can order in the US. So we actually do a lot of things. I wear Skechers shoe. So once I wear Skechers shoe, I ask a lot of people and understand, and then I look at that balance sheet. So we take a lot of care because it is our money. Tomorrow, all of our employees and the partners will be investing in this strategy. Like half of them are already invested. I'm only managing my money. You are glued to it as a performance sharing partner, as a general partner. That's the thing we do. We sleep, we eat, we walk, we talk our companies, but we are not attached to them. Because if any company we find that there is an issue with the earnings, because the basic is business, you have to always focus on the business. We are so glued to the business. We are reading their balance sheets and annual reports, meeting their employees, understanding are they growing people, are they hiring more people. This is what we do. That's how we ensure your capital. And I cannot tell that into words because it's an ongoing thing. It's actually a passion. And I think Warren Buffett read 400, 500 pages a day. I read 50 to 70 pages a day. So that's what we do.
Yes, Bhuvan, I think that's the end of the questions.
So I'm on time. I think 2 minutes are overshooted. Thanks a lot. It was great talking to you. Believe me, feel free to talk to my team and me, and we have nothing to hide. All we want is to you have $1 million with you. I thanks to Srinivas for getting us a lot of people in Oman. Before you leave, please write your name on the chat and leave the place name. Let's say if you're from Oman or Australia or from Dubai, please give us your name so that we can send you a thank you email. Please circulate this to a lot of your friends who would like to retire rich. At the end of the day, it is you who makes money. We help you to reach there. I'm thanking all my team members who have designed the presentation, tirelessly worked towards the marketing and the digital media. Romesh, thank you for introduction. Padmapriya, thanks a lot for basically helping me out with the Excel sheet. Arun, thank you for the feedback you have given. Rohit, thank you for designing and inputting the presentation. The next presentation, which we are going to do, and I'm announcing right away, is about the behavior investing. We'll talk about the behavior investing and how we have, and we will also tell you how we could have even done much better in our mistakes for 2020 while managing the portfolio, which will tell you more that even after doing those mistakes, we are at 40%. Thank you. Have a great day. Have a great good evening in other cities. Have a great good morning in US. Have a good day. Thank you. And keep investing.